and start letting attendees join. We'll give it just a minute and then we'll go ahead and get started. All right, I see people filling in now. We'll give it another minute and then we'll begin. All right, I'm sure people will continue filling in over the first few minutes or so, but we can go ahead and get started. So good afternoon, everybody, and welcome to our Q4 Financial Markets and Portfolio Update webinar with Chief Investment Officer Steve Galli. We appreciate you joining us this afternoon for our fourth quarterly update of 2023. So if you have any questions during the webinar, please put them in the Q&A box and we will get to them. And I know there's a lot to discuss today. Steve has plenty of updates to cover. So with that, I'd like to introduce Steve to take it away.
Thank you, Katie, and thank you all for joining us today. I know your time is valuable. Hopefully this will be informative and interesting and fun all at the same time. So we'll just get right into it. As everyone hopefully knows at this point, we kind of just basically want to make sure that we cover what's going on in the financial markets, what's relevant and what does that mean for portfolios and our investment strategy, because we're always dynamically adjusting those portfolios based upon what's happening in the marketplace. And then, of course, at the end, we will have time for Q&A if anyone has any questions. So it's always interesting to see, what some of the big headlines are that are in the financial press. This is one from Barron's Magazine about, what's been happening with big tech stocks, specifically in the last quarter, the third quarter, and how, they did get beaten up a bit, but, Barron's is saying, well, that's a good time to buy. I'm not so sure about that, but, obviously there's the terrible situation going on in the Middle East. This is a recent headline from Bloomberg. We have a lot of talk about what the Federal Reserve, and this is Jerome Powell, the head of the Fed, what they may or may not do in regards to interest rates. And then, of course, no one can stop talking about AI or artificial intelligence. Some people are saying that's, the next big, revolution to occur to the market since the PC or the personal computer was created. So we'll talk a little bit about that. But before we dig into a lot of what's happening in the United States, I did want to just point out that, obviously we also pay attention to what's happening globally because, the global economy is important. I mean, because obviously a huge chunk of revenues from a lot of U.S. companies come from abroad. And not only that, we also do focus on allocating certain amount of assets to international stocks because it's very important to be diversified, across the globe. But the numbers that are coming out of China, and the reason I think it's always important to keep an eye on China is because it is the second largest economy in the world. And right now, China is struggling a bit. A lot of people thought China would be a lot stronger this year as a result of, finally getting out of the lockdowns that they had imposed during the pandemic. But that really hasn't played out as planned. Investment flows into China have dramatically reduced, as you can see by the chart on the left. A lot of that has to do with a lot of uncertainty around regulation. A lot of the crackdowns that have occurred in various industries, especially the technology industry. There's obviously a very delicate and unfriendly political situation between the China and U.S. as a result of a lot of technology, intellectual property. There's, in addition to not only that, there's also this demographic problem that's playing out in China, which is, and I think this is a fascinating chart on the right. This is a prediction by the UN Population Division that does these studies. And the dotted line was, only a few years ago, the UN was predicting that the working age population of China would decrease from, basically over 1 billion people to less than 600 million They recently revised that projection to now that they're projecting that the working age population, over the next several decades is going to decline to less than 400 million. So that's a big problem when you have such an issue with not having a productive workforce, as your economy grows. So again, a lot of things that we need to pay attention to with China, because that does have an impact on companies' ability to generate profits there, as well as just the global economy in general. So I thought that was interesting to take a look at. But so if we talk about really what happened last quarter, in addition to the whole first the first half of the year, in addition to the last quarter was tough. Third quarter, unless you went into high yield debt, which was one of the only sectors that actually squeaked out a decent return last quarter, you essentially assets lost value. It didn't matter whether you were in large cap, small cap, US, international, whether what type of bonds you were in, they all suffered last quarter. And why was that? Well, part of the reason was the first half of the year was pretty strong. So I think equity valuations probably got ahead of themselves. So there was definitely a pullback. In addition to the fact that yields in terms of interest rates have kept going up last quarter. And when yields go up, obviously, hopefully everyone knows there's an inverse relationship between yields and bond prices. Yields go up, bond prices go down. And that's exactly what played out last quarter. So it was definitely a rough quarter. On a year-to-date basis, still pretty good. On average, if we look at most U.S. large cap indices, they're still in the double-digit positives. So the year has still been okay overall, but obviously last quarter set us back a bit. And this kind of shows, on a month-by-month basis last quarter, some of the key things that came out. There are a lot of things in here, but one of the things that I think are interesting is, that make me a little nervous sometimes is, so NVIDIA, I'm kind of mousing around it right now. What's NVIDIA? Well, NVIDIA is, one of the largest stocks in the world. And one of the reasons that it's gotten a lot of attention is that they produce some of the fastest chips in the industry. And those super fast chips, for a long time, they only used to be used for gaming programs, gaming software, because graphics are intensely use a lot of chip power. But now with the artificial intelligence hype and move towards and lots of companies moving towards using a ton of artificial intelligence in everything they do, they also need super fast chips to process all that information. And NVIDIA is the main producer of those fast chips. So that's why NVIDIA stock has done quite well over the last couple of years. So their quarterly earnings came out, and I think this was around late August, and they had an incredible earnings report. I mean, it just blew everyone out of the water, which actually demonstrated how much demand there is for their chips, especially for artificial intelligence. But the thing that made me nervous is that even though their earnings were off the charts, the stock actually hasn't really moved much. If anything, it's actually gone down a bit since that earnings report, which tells me that I think if that a lot of those big cap, large cap tech names are fully valued. The market has already kind of priced in all the forward-looking positives. And now, if we see anything negative, I think those stocks have the potentially pull back a little more. So, the bond market also has thrown us some interesting curves, no pun intended. So, this is the yield curve, and the yield curve basically charts the maturity of bonds over time, and this goes everywhere from 1 month to 30 years. And it also shows the interest rate level on the left. So 2 years ago, and that wasn't that long ago, but it kind of seems like a long time ago. 2 years ago, you could buy a 1-year treasury bond, and you know what you'd get? Almost nothing. You were lucky if you got 2.2%, right? Not great. And if you bought the 10-year, if you actually gave the government, gave them a loan for 10 years and bought a 10-year treasury, you'd be lucky to get about a 1.5% yield on that. So that's where we were 2 years ago. Now, a year ago, that's when we got the inverted curve. Why is it inverted? Well, because the 10-year Treasury a year ago was giving me about 3.9%, and the 2-year was giving me about 4.3. That's inverted. Inverted means short rates are higher than long rates, and that's not supposed to be the normal situation for bonds, right? Normally, you would think you'd have to get a higher yield for a longer term bond. You know, why would you take the risk of buying a long term bond if you're not going to get a higher yield? So, what does it look like right now? Today, still inverted. But there's a big difference, right? The 10-year, remember a year ago, the 10-year was yielding only about 3.9%. Now the 10-year is yielding about 4.5%. Big difference. Short-term yields are even higher than they were a year ago. So the curve is still inverted, but a lot happened in the last year, especially even in the last couple of quarters. And the rise in those longer rates, and maybe this chart right here shows that better. This shows what happened this year. This is where the 10-year was at the end of the second quarter, the yellow line, right? And this is where it is now, or where it was at the end of the third quarter. That's a 1% move in basically 3 months. And a 1% move for a bond is a lot, right? So, and what does a lot mean? What is the impact? Well, let's just do a little bond math right now. You know, so when you talk about a 10-year bond, a lot of people measure a bond's risk by the concept of duration. So what is duration? Duration essentially is a really interesting metric because it tells you a few things about a bond. And so, for example, on a 10-year Treasury bond, the duration roughly is about 7. What does the number 7 mean? Well, what that means is on a 10-year Treasury bond, if the duration is 7, it essentially means that in 7 years, you should expect to get your money back from investing in that bond. Now, you might say, well, why is that? It's a 10-year bond. Don't I get my money back at the end of 10 years? Yes, you do. But the idea is in 7 years, you will at least get your original investment back. So what do I mean? And how does that work? So if the duration of a 10-year Treasury is 7 years, why does that mean that's when I get my money back? Well, think about it. Let's say a 10-year Treasury bond yields about 5%. Okay. So every year, let's say you invest $1,000 in a 10-year Treasury bond. Every year, you're going to get paid what? $50, right? 5%, $1,000, you get $50. And what are you going to do with that $50? Well, the way duration works is it assumes that you reinvest that $50 at that same rate, 5%. Now, of course, you're not always able to do that, but that's what the duration assumes. So in the first year, you get $50 back and you invest that $50 at 5%, which means the next year you're going to earn $2.50 on that $50 and on and on. So basically, if you get $50 back on that 10-year bond every year, right? That means after 7 years, you're going to have what? Well, you're going to have $350 of interest, which you will have reinvested over those 7 years. So that's kind of the way the bond math works, saying, hey, if your duration is 7, that kind of means that's how long you have to hold that bond so that you at least approach break even. Now, more importantly, duration also tells you the sensitivity to the interest rate of that bond. So if interest rates move up or down by 1%, that 7 number means you can expect your bond price to move up or down accordingly. So if your bond's duration is 7 and interest rates move down by 1%, it means the bond price will probably go up around 7%, which is pretty awesome. Conversely, if the duration is 7 and interest rates go up by 1%, what's that going to mean? It means your bond price will probably go down by about 7%. And that is exactly what happened last quarter to a lot of longer term bonds. Interest rates went up, bond prices went down. Now, that's one of the reasons why in portfolios we have a lot of different maturity bonds. We don't just invest in long-term bonds. We actually have a lot of shorter term and intermediate term bonds, which have lower durations and therefore are less sensitive to interest rate movements. That being said, though, we do think that after the interest rate movements that we've seen, adding duration or adding longer term bonds at this point in time probably makes a lot of sense, because I think the worst is behind us in terms of those dramatic increases we saw in long-term rates. So this chart here is the Federal Reserve's, or the Fed funds rate. This is what the Federal Reserve controls, right? This is the short-term interest rate that the Fed sets, which is basically the level at which banks can fund themselves from the Fed. So you'll see where it is right now, which is hovering right around 5.4%, right? So the big question that everyone's talking about is the Fed going to continue to raise that number? Right now the market thinks that they might raise one more time by another 0.25%. But then the market, and by the dots, this is kind of what the market thinks may happen. The dots tell us what the market thinks the Fed is going to have to do eventually, which is to cut rates. But, I have to tell you, I think the market is always over optimistic about the Fed's ability to manage the interest rate scenario here. Because if you look at, and this is basically showing us the last, 20 plus years or so, when does the Fed ever get it right? And what I mean is, there's always a history of the Fed raising interest rates. For example, in the early 2000s, what did the Fed do? They raised interest rates. They raised and raised and raised very gradually. But then what did they have to do? Well, they caused, this is of course at the great financial crisis of 07, 08. What did the Fed have to do? They had to cut rates dramatically, very quickly, down to zero. Then they did it again, right? In 2015, they started raising rates gradually, ever so slightly, every quarter, on and on, until what happened? Well, something broke, and they had to cut rates dramatically again. Now, obviously, that was a result of the pandemic. But the bottom line is the Fed always ends up cutting rates really fast. And why do they end up cutting rates really fast? It's because eventually high rates cause something to break. In the great financial crisis, it was the mortgage market that broke. And that had a lot of ripple effects to the rest of the economy. The pandemic, obviously, that had a lot of problems that the Fed had to try and correct by making interest rates zero. So my point is, why do we think that the Fed is not going to have to cut rates dramatically in the next year or so? Because eventually the higher rates are going to have a negative impact upon our economy, and that's actually starting to play out. So let's talk about inflation, because this is one of the things that the Fed is battling, is the inflation picture. They are having some success, right? So these charts here show us what is happening to inflation as measured by the CPI, where it's going, and what consumer expectations on the right of inflation are. Consumer expectations of inflation are important, because if the consumers think prices are going up, that can be somewhat of a self-fulfilling prophecy. So in this case, consumer expectations of inflation are coming down. That's a good thing. But the Fed's job is not done. Yes, inflation has come down from the very high levels where we were only about a year ago, where it was close to double digits. But it is still hovering around 3 or 4%, way off the Fed's target of 2%. So the Fed is not done. The question is, are the rate levels that they are at now enough to keep inflation coming down, right? And that's what's not clear. I would argue that they probably are, right? Because if we take a look at what's happening to the consumer, right? And why do we care about the consumer? The consumer matters because they represent about 2/3 of our economy. The consumer, while their debt levels of the average consumer are still looking pretty good, although it's come up dramatically since the bottom of the pandemic when people weren't able to spend money. All that excess savings from the pandemic is starting to disappear, right? And why is that? Well, things are a lot more expensive today, and people are using their savings to buy the more expensive things. And as we always talk about, wage growth is slowing. Wage growth is a leading indicator of what may happen to unemployment. Because if wage growth is slowing, that usually means that unemployment is going to creep up soon, right? So we'll talk more about that in a minute. But when I talk about the consumer, why does the consumer matter? Well, this kind of shows the long run trend of the US gross domestic product, or GDP. And if you look at the components of GDP, the blue box here, 2/3 of GDP is essentially consumption, or a little more than 2/3. And what is that driven by? It's driven by the US consumer. What are the US consumer buying? And if we think that the consumer is weakening, that probably means the economy may weaken. And if the economy weakens, what does the Fed have to do? The Fed has to not only stop raising rates, they'll probably have to cut rates, right? So this is kind of what the market is wrestling with, because obviously rates matter. And let me just get back to that unemployment thing. Unemployment is the last domino to fall when it comes to what I'll call economic health of our economy. So it's a lagging indicator. So usually by the time unemployment starts rising, it probably means that we may be already in or starting a recession. And so this chart is really cool, because this chart shows that there's almost a perfect inverse relationship between wage growth and unemployment. So remember how I said wage growth is slowing. So wage growth is the blue line. This shows wage growth going all the way back to the early 70s. And so this blue line right here is telling us that wage growth has been slowing. So why would wage growth be slowing? Well, that's because companies maybe aren't doing as well. So they're not having to hire people as aggressively, and they're not having to pay people that are already there as much as they used to be. So wage growth is slowing. And when we see wage growth slow, what inevitably happens as a result, and this is the leading indicator, is that unemployment moves up, right? So you can see every time wage growth slows, unemployment moves up. And where is unemployment now? Well, unemployment is sitting around multi-decade lows. Eventually, as a result of this blue line coming down, which is wage growth slowing, this black line, which is unemployment, will move up. And when unemployment moves up, that's when you know we're in trouble. That's when you know we're probably already in a recession, okay? Now, the question is, when is that going to happen, right? And I wish I could tell you exactly when it was going to happen, and quite frankly, no one can. But our best guess of when that's probably going to play out is probably the second half of next year. By the way, stocks, or the stock market, actually tends to peak about, on average, 6 months before a recession. So if we think that the second half of next year is when the recession may all start in earnest, it probably means at the beginning of next year is when we should really be pretty cautious, right? So not necessarily cautious right now. We don't want to jump the gun, but we're going to have to keep an eye on this. And so why are things slowing down if things seem to be going pretty good right now, right? If the consumer is relatively healthy? Well, look at what's happening to credit card rates, and look at what's happening to mortgage rates. And as any of you know, if you're looking to buy a house and you've been looking at current mortgage rates, they are sitting at, basically multi-decade highs. That's not good for prospective buyers. That means the housing market slows. And when the housing market slows, that tends to have a detrimental impact on the economy. In addition to the fact that high credit card rates, well, look, the average consumer carries a decent load of credit card debt. And these higher rates are not going to give them a lot of excess spending power to keep driving our economy forward. So this is usually what happens as the result of the Fed raising interest rates. There's kind of a lag effect. It takes a while for all those rate rises to impact credit card rates, to impact mortgage rates, and then to impact the end consumer. And that is what is beginning to play out. And that is why we are concerned about all this kind of playing out in terms of a recession in maybe the second half of next year. By the way, does this matter for the stock market? Yes, of course it matters, because I think this is a really busy slide. So, but I'll just zero in on the kind of the headline here. Who really owns the market? Well, basically, and this is a study by Goldman Sachs, about 40% of all stocks, of all US stocks, are owned by you and me, households, right? And that's the biggest owner of stock, not corporations, not foundations and endowments, not the government. It's us. We are the biggest holders of stocks. And if us as the consumer starts to feel the pain of all these higher rates, well, what are we going to do? Are we going to buy more stock? Probably not. As a matter of fact, we may have to sell some stock. So that is why, these things really matter. Now, interestingly enough, you and me as the consumer, we don't own a big chunk of all the bonds out there. We actually own about, a little less than 10% of US Treasury bonds. So our health doesn't matter so much to the bond market, but to some degree. So anyway, I thought that was interesting to point out. And so when we talk about the equity market, this is what the equity market looked like a year ago. And, so what was going on a year ago? So I always love to show this slide. Hopefully you guys aren't sick of this slide by now, but I think it's really important to look at because the middle dotted line here is the 25-year average of the forward PE ratio of the S&P 500. So it's generally a good proxy of the market valuation, right? And as you can see, the 25-year average on a forward PE ratio basis is about 16 to 17 times earnings, meaning for every dollar of earnings I want to buy in the market, I usually have to pay 16 to 17 times that dollar to buy it. Well, last year, a year ago, the valuation was below that average, right? So things were not expensive. They weren't necessarily really cheap, but they were definitely below the long run average. And what was going on? Well, if you remember a year ago, inflation was out of control, right? That's when we had almost double-digit inflation. The Federal Reserve was hiking rates like crazy. And everyone thought a recession was going to happen like right now, actually. Everyone predicted we'd have a recession this year. Well, and that just goes to show the old saying is that economists have correctly predicted 12 of the last 5 recessions, right? No one's really good at doing that. But that's one of the reasons why last year the market was below its long run average in terms of valuation. So actually that wasn't a bad time to buy. And, so where were we 3 months ago? Or rather at, basically at the end of the second half of the year? Well, things were a lot more expensive, right? They came off their lows and the market started to approach what I consider to be very, relatively expensive territory, right? This dotted line is one standard deviation higher than the long run average. And so when you get above this line, as we did after the pandemic and as we did after the dot-com bubble, inevitably it's going to dip back below that line. It doesn't stay that expensive for very long. And so we were headed that way. And we talked about this last quarter, that maybe caution was in order as a result of this expensive valuation. And guess what? We were right, because today we have come down from that kind of expensive zone that we were 3 months ago, and we are getting closer to that long run average. Now, things are still relatively expensive, but certainly not as expensive as they were 3 months ago, right? And so now let's dig into that a little bit. This is a busy chart, but what's really been driving the market this year? Well, at the end of the day, it's still been all about big tech, growth, and large cap. This is basically showing us year to date that, the sectors that did really well. Communication services, by the way, communication services, that's pretty much Netflix, Disney, and Facebook. No, not Disney, because Disney actually hasn't done that well this year because Disney Plus is suffering. But it's really Netflix, Facebook, and Google. Those are communication services stock, and you would think, why isn't Google a tech stock? Well, it's kind of actually a tech stock, but Google's a communication services stock because it has YouTube. But anyway, basically, higher risk, higher growth tech names are what drove the market this year. What else drove the market? Well, again, those types of sectors are more growth oriented. They tend not to pay dividends. You buy them because you want the share price to grow up. You don't buy them because you get good dividends. That's more value. So far what we've seen this year is growth has done really well. Value, not so much. Also, large cap. It's been all about the big tech companies. Large cap has done really well this year. Small cap, represented by the Russell 2000, has not. But what does that mean? Well, it actually means that value stocks are probably a lot more reasonably priced and probably not a bad time to get in versus growth. And the same thing, small cap stocks, probably more reasonably priced, not a bad time to get in versus large cap. One of the other things that I think is a little dangerous is that really only 10 stocks have driven a huge portion of the gains of the market this year. So what do I mean by that? Well, let's take a look at the chart on the left. The top 10 names in the S&P 500, which have almost a 30% weight of that index, which shows how incredibly important they are, they've driven, and this is by the end of the third quarter, they drove over 11% of the S&P's return for the year. What did the other 490 stocks contribute to the return? Less than 2%. It's been all about the big cap tech names. And by the way, what are those 10 names? They're kind of down here in the fine print. It's Google, Amazon, Apple, Berkshire Hathaway, Exxon, Meta, which is Facebook, Microsoft, Nvidia, which we talked about, Tesla, and the United Health Group, big healthcare conglomerate. So those are the 10 names that have driven a huge amount of the returns this year. Now, obviously, in a lot of our portfolios, thank goodness we have plenty of exposure to those 10 names. But the point is, they're expensive, right? On a price to forward earnings basis, this is the yellow line here. They're expensive compared to the rest of the market. Probably not a bad idea maybe to pull back some of the gains that they've had and reallocate into some of the lesser known or lesser returning stocks in the rest of the S&P 500. So that's, I think, some of what we're thinking. But this is a fascinating slide. I know it's really small, but if you just look at the colors, and I'm kind of colorblind, but I can kind of see them. What do these colors show? Well, black is Google, yellow is Apple, green is Meta, and the pink or fuchsia or whatever color that is Microsoft. So this is a cool chart because this actually says who owns the internet, who has a dominant market share in probably one of the most important things that we use every day. And so you can see that there's a reason why a lot of those big cap stocks have done so well and are so important. It's because they have a majority share of everything that has to do with the internet. The lone exception is this second column here, which is really the PC market, which still is very much dominated by Dell, HP, and Lenovo. But if we're talking about mobile, well, Apple is a huge player there. The operating system that drives all the computers we use, well, that's all about Apple and Microsoft. Browser, as in the internet, which all of you are using right now, hopefully, to watch this webinar, well, that's dominated by, guess who? Google, Apple, and Microsoft. Search engine, incredibly dominated by Google, and on and on. So that's one of the reasons why, and I shouldn't leave out the last column here, which is really social media, which is heavily dominated by Facebook, which also owns Instagram as well. So this is why these stocks are important, and this is why the market has been so focused on them and why they have generated outsized returns relative to every other stock. And you can't ignore them, right? You can't ignore them. They're an important part of portfolios, but you need to recognize when they get probably more expensive than they should be. So what does this mean for what we're thinking about this quarter, or rather the last quarter of this year? So as I mentioned, I really think we need to watch the labor market because it is cooling. And inevitably, that declining rate of wage growth is going to translate into unemployment going up. And that's when we're in trouble, right? So I also am nervous about the fact that we saw that that consumer debt in relation to credit card rates, that's going up. Mortgage rates are already way up. That's going to slow things down. That's going to have a negative effect on the average consumer. That's going to have a negative effect on the economy. I talked about how stocks can peak about 6 months before a recession. Now, again, no one knows when the recession is going to happen, but it's a reasonable assumption to think sometime next year, probably the second half of next year, which our guess is, therefore, we should probably be pretty cautious the next time we meet and talk about this, which would be in the first quarter of next year. AI, right? Do we still need to have a lot of exposure to AI stocks? Yes. Do we need to be careful about getting overexposed to the AI hype? Yes. So that's something we're monitoring closely in the portfolios. We want to make sure we're properly balanced. And of course, is the Fed going to raise again? I think right now the odds of the Fed raising rates next month are, I want to say the market is assuming there's a 12% chance of a rate hike next month. I'm not going to try and outguess the market. Maybe that's true, maybe it's not. Either way, that's going to have an impact on both the bond and the stock market, because if the Fed stops raising or signals that they're finished raising, I think the stock market's going to like that. If they raise again, I think the stock market's going to not like that. So that's going to be an interesting thing to watch. And, obviously there's a lot of geopolitical issues going on. The world is now a much more dangerous place than it was certainly a few years ago. And, that is not, that creates a lot of uncertainty. The market doesn't always like, or never really likes, uncertainty. So obviously those geopolitical conflicts, especially the horrible things happening in the Middle East, that can have spillover effects, especially if it ends up into a larger conflict. So that's obviously something to pay attention to, and hopefully that doesn't doesn't become a catalyst for larger issues and then larger negative impacts on the market. So again, that's obviously something to keep an eye on. So what does that all mean for portfolios? Well, as I mentioned, obviously getting defensive at the end of the first half of this year was good, because third quarter wasn't pretty. So that definitely paid off in portfolios. Now, though, after that sell-off that we saw in bonds last quarter, yields are attractive, right? We're doing a lot of investing in bonds for clients, and I think that's going to end up being a really good thing for them, because inevitably, if you can buy, short-term to intermediate-term corporate bonds that are investment grade, meaning relatively safe in the eyes of the credit rating agencies, and you're getting a 6 to 7% return on those bonds, well, that's pretty good, considering you're taking a heck of a lot less risk with a bond than you are with a stock. So, bonds are definitely a lot more attractive now. Stocks, obviously, as a result of what we were talking about, after having a rough quarter last quarter, they are more reasonably valued. Not really the big guys, not those big tech names. They're still pretty expensive, but a lot of other stocks are more reasonably valued. So what that means is that we are going to be adding to credit in the sense of bonds, and duration in terms of corporate bonds exposure to portfolios. And we also think it's time to shift away from what we think are more expensive stock sectors like big tech, big growth, large cap, into a little bit more reasonably attractively valued sectors, smaller caps, more dividend-oriented, value-oriented stocks, and maybe some sectors that haven't been very loved lately, like healthcare as well. So that's really what we're doing. And many of you may have noticed that a lot of trades have probably happened in your portfolios already this week. And of course, we're happy to have more individual conversations with any of you if you have more detailed questions. So with that, I'm going to pass it on to Katie to see if we have any questions that came in during my hopefully not too long-winded presentation.
Hey, Steve, you covered quite a bit. This is Elena. One of the questions that we wanted to ask is going back to the conflict and war in the Middle East. Do you see that affecting the financial markets and portfolios, or what should be worried about in that regard?
Yeah, great question. And we've been getting that question a lot from clients. What does that mean? What should we do? The interesting thing is, if you look at correlation of the market to, let's say, the history of warfare, in the world going back, at least 70 to 80 years, there is no correlation. Meaning, usually, war doesn't necessarily mean that the market is going to go down. Perversely, sometimes the market actually can go up in times of war. So there's really no direct correlation to geopolitical conflict and the market. There definitely can be some short-term effects, but in the long run, or even in the intermediate term, usually not something that you can count on to predict in terms of what the market's going to do. So that's why, we're very cautious about trying to make any changes as a result of situations like that, because it's not really clear that making a change is going to be the right thing to do based upon, these geopolitical situations. So that's why, we counsel not to really make dramatic changes as a result of some of those developments.
Okay, that makes sense. Another question in the chat. What's your take on REITs? Is it worth the investment?
Yeah, so REITs, what's that? REITs. What are REITs? Well, that's an acronym for Real Estate Investment Trusts. And so what are real estate investment trusts? Well, there are private versions of real estate investment trusts, and then there are public versions of real estate investment trusts. They're traded on a major stock exchange. And really what they are is a amalgamation of a bunch of different real estate investments, wrapped up into something that, you or I can buy into, right? And so certain REITs specialize, let's say, in warehouse storage. Other REITs may specialize in multifamily housing. Other REITs may specialize in residential housing. Other REITs may specialize in, small commercial properties like, strip malls. So the short answer to that is not all REITs are the same. Not all REITs are created equal. Some REITs are going to be doing better than others in this market. For instance, commercial real estate right now, I think, is at a big risk. And why do I say that? Well, as we talked about, interest rates have come up dramatically. So I actually have a friend of mine who's in the commercial real estate business. A lot of what commercial real estate, people do is they finance the commercial buildings that they own with debt, right? So they're usually leveraged, and usually highly leveraged, right? They use a lot of debt. Once that debt comes due, they usually have to refinance it. So this friend of mine is actually quite nervous because he has a lot of his commercial real estate financed by very low interest rate loans. And guess what's going to happen when those loans come up for refinancing time? He's going to have to refinance at a lot higher rates. And if he refinances at really high rates, if he can even refinance at all, well, guess what that means to his profits? They're going to drop dramatically, right? Because his interest rate margin is going to be pretty tough. That's not going to have a good impact in general, in my opinion, on commercial property REITs, right? Now, there's some other commercial property REITs like warehouse storage, which are probably doing pretty well. Warehouse storage, thanks to Amazon, who wants to, it seems like Amazon builds a new warehouse for storage every other day. That's actually performed quite well. Public store, self-storage properties have actually performed really well. So again, I think the answer is it depends, but in general, rising interest rates tend not to be too great for the real estate sector in general. Obviously, the residential housing market is going to suffer as a result of that. Why? Because it's harder for me to buy a house. I have to pay a lot more for my mortgage, so that makes me less excited as a buyer. One of the only reasons why housing prices actually haven't come down too much as a result of those higher interest rates is because we're in this weird situation where we have very low inventory, and that has another impact on the housing market. So not to get too long-winded here, but that's kind of an answer to that REIT question. I think the answer is it really depends on the REIT we're talking about, because REITs have different specialties, and that's going to, the prognosis for those REITs is going to matter in terms of what they're focused on.
That makes sense. There was one more comment in the chat, and it was more exposure to defense stocks, oil stocks.
Sorry, was that exposure to oil or energy stocks?
Defense stocks, oil stocks.
Defensive.
Mm-hmm.
Okay. Well, first of all, energy stocks are not defensive. Energy stocks tend to be they're sensitive, right? Energy stocks tend to be very sensitive to the economy, and that's the term sensitive means if the economy does well, energy stocks tend to do well. If the economy doesn't do well, energy stocks tend to not do well. So defensive stocks, however, are more of those stocks that you buy when it doesn't matter what the economy is doing. Like it's the old, there used to be a term like the lipstick stocks, right? Because what do women do if the economy's crappy? Well, their husband's not going to tell them to go out or buy them a new diamond ring, but they probably will be happy if they go out and buy some lipstick, right? Because, that they're going to buy lipstick regardless of what the economy is doing. So Those are like consumer defensive stocks, like a Procter and Gamble, for example, Unilever. You're still going to buy Ben and Jerry's ice cream no matter what the economy is doing, or maybe not as much, but you're still probably going to buy your ice cream. You're still going to buy your toilet paper. You're still going to buy tissues. You're still going to buy paper towels. That's like a Kimberly-Clark. These are consumer defensive stocks that tend to do well even if the economy is not. So healthcare too. I don't care what the economy is doing. If I'm sick or really sick, I'm going to need to see the doctor, right? So they tend to be known as more defensive type stocks. So that's what we mean by defense. And those stocks actually have not been loved this year because this has been a year about growth and tech, and those sectors aren't really about that. So if things go south in the market, probably the sectors that get hit the most moving forward are the growthy techie sectors, and the sectors that will be more stable and do better in a bad market are those defensive sectors like consumer defensives, like healthcare. So that's kind of what we mean by sector rotations.
That makes sense. So I'm going to read a comment and ask you to kind of respond to it. I keep hearing about the unemployment rate and its effects on markets. I find that unemployment rate is not the issue. How are the people not willing to work affect the unemployment rate and directly the market thereafter? In follow-up, I had 3 locations and 50 employees, and now I only have 1 because fewer people are entering the trades and actually want to do the work and get dirty.
Right. So a lot going on there in that question. Look, why do we talk about unemployment? Well, at the end of the day, if people are working, they're making money. And if people are making money, they can spend money. And as we were talking about, if over 2/3 of our economy is really dependent upon the consumer, right? And if the consumer is healthy and has money and they're spending money, that usually means good things for the economy, and good things for the economy mean good things for the companies that are in that economy because they're making money. Higher unemployment means there's less money being made by the consumer and therefore less money being spent, which generally means that the average company earnings, because almost every company is affected by consumer health, is going to go down. Right. And so that's why we care about the unemployment rate, because it will have an effect, at least in terms of market, it will have an effect on the stock market because stocks tend to not do as well as unemployment is rising. There's just less money going around. Right. And now, at a certain point, if unemployment if unemployment keeps going up too far, right, there's kind of a breaking point where that's when the Federal Reserve has to start cutting rates dramatically, because obviously the economy will be slowing down, companies will not be doing well. And what does the Fed have to do? They have to cut rates so that benefits everybody. That means companies can spend more at lower rates. Maybe they can build that new factory because they can finance it at more attractive rates. What does building a new factory do? They're going to have to hire people to do it. And that's going to have an impact on the unemployment rate, and there's a trickle down effect, right? So that's really why that rate matters. I mean, again, it's hard to see things on a very short-term basis. We never really know what's going to happen in the immediate term, but this is generally what matters in the long term. And why also and the reason why we haven't really seen a higher unemployment rate is because things have been okay, right? We just came out of probably an unprecedented time of stimulus. We had tons of government stimulus as a result of the pandemic. We had the Federal Reserve pumping as much money into the economy as possible as a result of the pandemic. And so that massive stimulus, both from the Fed and the government in the way of handouts, has still not quite worn off, right? It's almost worn off, but not quite. And that is one of the reasons why we still have such a low unemployment rate, because all that stimulus was, that was wonderful, right? And so, but now that that's kind of worn off, it's kind of, we're getting a little bit back more to what I would call normal, the normal reality of not having all this money being thrown into the system. And so that is why we expect things to kind of get back to what we would expect to be long-term, more normal rates in terms of unemployment wage growth, inflation, et cetera. So that's kind of, you know, how I think it matters looking forward.
Perfect. Well, we are up on time. Thank you for everybody's questions. Thank you, Steve, for going through all of this. If you have additional questions, feel free to reach out to us directly or make comments in the survey that you're going to see here in a little bit. Also, we will be sending a recording of this early next week along with commentary. So if you missed anything, you'll be able to catch it then. So I hand it back to you, Steve.
All right. Well, thank you, Alana, and thank you everyone for joining. Always a pleasure, and we look forward to next time. And please send in those comments. We want these to be, you know, as informative as possible.